Good afternoon, everybody. It's Close of Business Tuesday, and we've got a fantastic guest, friend, and energy leader to help us think about the world in 2021. I'm really pleased to welcome Jeffrey Harris to the show. So many of you out there know Jeffrey. He was a longtime Warburg Pincus private equity leader and investor. In 2012, he started his own group called the Global Reserve Group. He's been on the board of many companies, energy and otherwise, public, private, etc. And at one point, he was chairman of the Venture Capital Association. So Jeffrey has been really focused on energy technology. He's been focused on so many things, and he's a great friend, and he's a lot of fun. So Jeffrey, welcome to the show. We're so glad to have you.
Thank you, Maynard. I appreciate the opportunity to speak with you and your colleagues.
Well, we're going to have some fun. Jeffrey's promised that he'll be irreverent as necessary. So I'm going to hold you to that promise, Jeffrey. Let's get started just to get our juices flowing, guys. A lot of things going on in the markets in the early part of the year. Mike Bradley, what color is the screen? What color is it going to be? What are people talking about? And yes, there is some kind of funny lighting going on with you, but we think it enhances your image.
Yeah, Maynard, the screen is green. You know, this is something we've been talking about for the better part of a couple months. That the equities were dialing something well below the strip. We're getting closer to the strip now. We still think there's ways to go, but what's going on? What's going on is a risk-on trade. People are basically buying into massive fiscal stimulus for 2021. That's what's leading to the 10-year government bond has gone from 90 basis points to almost 120 basis points in a month. That's a big, big move. So there is a risk-on trade with equities. We've seen the dollar weakness. We've been talking about an inflationary trade is starting to get into equities. We think that's going to continue, and that's one of the reasons why energy has basically moved up so dramatically here. It's the best performing sector year to date and was the best performing sector in Q4. You know, just to give you an idea of how much money, can still come into this group. We talked about the group being 2.5 to 2.6% of the S&P. That's sort of the lowest level ever. If you just get back to Q1 3.5% S&P range, that's an additional $300 billion of market cap that can come back to this group. If we get to mid 2019 levels, which is around 4.75% to 5%, we're talking about additional 700 to 800 billion in market cap that can come back to this group. So, a lot of people are talking about ESG and energy transition and dogging this group, but there is a long way to go. You see macro dollars coming into this group can still go a long way from here, and I think that's what we're seeing right now. So the screen is green. This is great. It's warranted, and so that's all we have to say about the situation.
So, Mike, how real is this inflation trade? How do you know if money is really coming into the space because of that?
Well, first of all, I think you're seeing the 10-year is going up, so it's starting to dial in some inflationary pressures, number one. Number two, if you look at base metals, copper, iron ore, all these things, they're hitting 5-year highs. You're seeing basically ags are basically going up substantially. So there is some underlying inflation out there. You're going to have substantially more stimulus in the second half of this year. And so I think that trade is a real trade, and it's something that really hasn't come into this market for 2 or 3 years. No one's been talking about inflation for the last 2 or 3 years. I think what you've seen with gold, with Bitcoin recently, it's telling you that the market is starting to believe there is going to be inflation, and that's something that's being dialed into some of these value equities that are beneficiaries of inflationary U.S. dollar trade. So it's real.
All right, great. Thanks, Mike. I think Matt and welcome back, Jordan McNiven. You guys were going to talk a little bit about what's going on in the gas space in particular, and I think everybody knows Jordan helps us look at a number of things, but LNG is definitely one of them. Now that I've stolen your thunder, Matt, why don't you tell us what's on your mind?
Yeah, thanks, Maynard. So this morning, the research team did a number of upgrades on the gas side of the space. And really our view is that we definitely see a potential for a material rally in natural gas, not only into the back half of this year, which we've talked a bit about on Close of Business over the last few weeks, but also potentially a material rally in the 2022 and 2023 forward curve. And so from an equity standpoint, The stocks have generally kind of lagged a lot of the oily names, which have moved up alongside the crude rally. And we now think it's time to be adding exposure, especially on the beta front, to gas equities. Just for a little bit of context, as we sensitize the models in 2022 and 2023 to the higher gas and oil prices that we are forecasting, we see a lot of these equities trading with a 15 to 20% free cash flow to EV and a free cash flow yield to equity that's approaching 25 to 30%. And so we do see the potential for a material rally in equities as we move forward. So with that, I'll turn it over to Jordan. He can kind of go through some of the basics on the macro front that are really leading us to have this high conviction call as we step into the back half of this year.
Perfect. Thanks, Matt. And maybe we'll start with the conclusions here. And really our conclusions are that we think gas is going to hit $3 here in the near term. We think $3.25 by the summer and $3.50 by year end. And then we see that strength carrying right into 22 when we're looking at a full year average price at $3.25. And to put that in context, the current strip's at about $2.65. And so we see material upside there. And the name of the report out this morning, I think, is aptly titled Hokkaido to Henry. And that really follows the sequence of thought process here and really market flows that drive us from what we're seeing in the LNG market right now back to Henry Hub. And to kind of walk through that really quickly, what we're seeing over in Asia right now is extremely strong demand driven by really cold weather. And so we've got places like South Korea, demand is up 17% year over year. In Japan, power prices are up 10x over normal levels. And so, really crazy amounts of demand going on, which is putting a strong bid into LNG. And on the LNG supply side, to coincide with this, we're seeing 7% of global supply offline for various reasons. And so very strong demand coupled with not much supply is driving JKM up to record levels. The knock on of this, and the next step down the geographic line here, is over to Europe. And because of what's going on in Asia, we're seeing basically all the flexible LNG cargoes diverted away from Europe over to Asian markets who are putting a premium into them. And Europe is instead relying on their natural gas storage. And so we've got LNG imports to Europe down 5 to 7 Bs a day, depending on the day, which is a massive amount for a market that's about half the size of the US market. And with that, storage draws that are hitting all-time highs as well. So by the end of the year, our year-over-year storage balances in Europe are down 900 BCF. And that frees up a lot of room for US LNG to refill that storage over the summer. And so that's where this all ties back to the US. And so we're not seeing US prices really participate in this upside right now that we're seeing in JKM and in TTF, but down the line, it is going to have an impact. We expect Europe to have record LNG imports over the summer. That means US LNG export utilization on our model is up above 90%. For context, that was 65% before all of this started to occur. And that's really what drives our pricing at Henry Hub higher. With the higher US LNG utilization, storage draws down, puts us in dangerous levels heading into next winter. And so how we solve that is through higher pricing and backing out power gen demand. That is really how we see the U.S. gas market playing out. So there you go. It's a bullish pitch, Hokkaido to Henry, and we're looking for $3.25 gas and $3.50 by year end.
So let me just ask you two questions. You mentioned JKM at all-time levels or super high levels. What are those levels, just so people can appreciate those numbers? Yeah.
So in the February contract, which is the kind of the active contract right now, you're seeing prices pushed well over $20. For more urgent delivery for people looking for a cargo in late January or even early February, we've seen pricing push through $30. And again, to put a little bit of context around that, if you think back to this summer when all the LNG cancellations were happening, we had JKM dip below $2. And so to now be over 30 just shows you how quickly things have changed in the gas market.
Jordan, you're talking about dollars per M, correct?
Dollars per MBTU, that's correct.
So that takes us a minute to pause on that one. Okay, the second thing though, you mentioned weather, and we're all used to the weather moving these forecasts around and these numbers around. Just generically, how do you as a forecaster get comfortable when something is weather driven that it can't, unfortunately, how do you bank on that? How do you factor that in? Because I'm sure all of us at some level are wondering that.
Yeah, we try to rely on the weather experts, and then of course if we get it wrong, we blame them. That is the tough for us, tough for investors to really have a pile of confidence in. Forecasting weather is a tough thing, but there are forecasts right now of potentially a polar vortex system hitting the U.S. That would certainly add even more bullish support to what we're looking at. At this point in time, you kind of have a decent amount of confidence in that kind of 2-week forecast. Beyond that, you do have to take a little bit of a leap of faith. But by the time we hit February, there's only so much winter left. And it's a very different story and a very different risk profile that you assume versus, say, when the market in October with all the winter still ahead of us. So, it does take, I think, a certain a bit of faith that weather doesn't go completely against you. But right now, when we look at it with limited weather to go, and we think that this trade is we have high conviction in it. And so a little bit of weather going against us the rest of the way isn't going to blow it up. But as always in the gas market, much like OPEC can always throw a wrinkle into the oil market, Mother Nature can throw a wrinkle into the gas market.
See, my job is easy, Jordan. I just get to ask the tough questions. I was going to make a joke. You're in Calgary, so you just assume it's going to be cold. That's an easier assumption for you. Teasing. Colin Fenton, before we get to today's guest, what's on your mind, sir?
Well, I guess I'd add on to both of those vignettes by pointing to corn and wheat and soybean prices. Today on the Chicago Board of Trade, corn and wheat prices are above 5% gains on the day. Soybeans are up 3.5%. So here you have Mike's inflation story. Here you have Jordan's real economy story kind of combining together. The punchline is that the agricultural harvests around the world in the year of COVID were down a little bit. And now we're starting to see the classic hoarding of the food. And we're not seeing as many exports as we normally would see. In the wheat market, the restrictions are coming from Russia. In the corn market, they're coming from Argentina. But the punchline is, much as we whimsically pointed out with potato chip prices, over however many months, and whimsically with Bitcoin prices, when you put this much fuel into asset prices, you should start to see monetary inflation and real asset price inflation, and we are seeing both most definitively.
So, Colin, you've had so much experience over the years looking at these things. Just one question. How do you distinguish between, quote, real inflation and the inflation associated with, I go to the local car dealer, plants have been closed, car prices are now up, some sort of temporary COVID-based inflation? I take it this has been something the Fed has been talking about a little bit.
Well, if you talk to central bankers, they will repeat the mantra that inflation is everywhere and always a monetary phenomenon. So it originates with the money supply. Now, obviously, there's a different kind of inflation that comes from price changes on disruptions, and you balance supply and demand through that kind of price change. But I think, the broader point for the COBT nation would be that when you have this much monetary and fiscal stimulus going out, 2020 will mark the most important bright line of the past 50 years in giving us a new FIC cycle, fixed income currency and commodities. Literally the year 2060, they will look back to the year 2020 and say that was the bright line. Now, we can have weather, as Jordan pointed out, we can have, hiccups in automobile production and the rest of it. That's not quite the same thing as the monetary inflation that I'm talking about. But whether you're an investor or a corporate treasurer trying to deal with wage inflation, cost inflation, the point is prices are going up. And so you're going to find that investors are going to be very interested in looking at natural resource and real economy plays. Take a look at any of the hydrogen economy efforts in equities that have been just on these moonshots. And then take a look at the derivatives of what will happen in agriculture and metals. And the history of these cycles is you're going to find a very sharp interest in rotating away from very expensive technology names toward the real economy.
Okay, that's awesome. Thanks, guys. That was a pretty, Jeffrey, as I was listening to all that was, some good oil comments from Mike, some good gas comments from Matt and Jordan, and then I guess they're good. Some inflationary comments from Colin, but meaning I mentioned in my lead-in, you started at Warburg in 1983, so 37 years around investing and around energy. What do you make, just to kick off, what do you make of this current landscape and how you're thinking about the big picture? And I know you tend to invest for very long-term horizons, but what do you make of what the guys just shared with us?
Well, I'm listening to them. I'm trying to determine whether this is a cyclical industry or we've gone into secular decline, and whether this is the dead cat bounce or something else. It's hard to say. My perspective.
I think we just had our first irreverent moment, Jeffrey.
Well, I don't have a
teasing you.
natural position, so it's a different perspective. My orientation has always been from the private side, much more so than the public side, and as you highlighted, much more on the long term as opposed to I'll call it the trading mentality, which I don't have. So I have to rely on others for those kinds of comments and perspective.
One thing maybe I could just pick up on Colin's comments, because Colin mentioned it's a great time if you're an investor to lighten up on tech and to think about resources or things that are more levered to inflation and protecting you. You do both. You've done energy, you've done technology, you've done venture capital. You look at lots of new companies with emerging technologies. What do you think about the intersection of technology and energy these days as you spend time in it?
So I think there's many dimensions to what you're asking about. Just regarding what Colin said, I put that into the category of trading thought. And I don't feel qualified to comment whether this is the time to lighten up on your position in Microsoft or whatever and buy Exxon. That's a different thing. Clearly, the intersection of technology, which is, by the way, too broad of a topic in many regards with energy, is something that's clearly going to be a huge force going forward, as it has been in the past. And I think that when you talk about technology, what I think you're really focusing on is companies that have high growth potential, as opposed to the oil and gas business, which I don't think has high growth potential from where we sit today. That doesn't mean individual companies don't have that potential, but as an industry, I don't think it does anymore. That's my comment about secular versus cyclical.
Well, I mean, I think that example you pointed to, Microsoft, Exxon, or Tesla, Chevron, I mean, that is the type of thing that's on people's minds. And it seems to have, not to comment on any of those specific companies, but this downturn, were you surprised at how the energy transition and SPACs and energy tech companies and how all of that exploded? And maybe it has so much to do with money supply and other things, but were you surprised at the phenomenon we've seen here over the last year and just how values and the markets did what they did?
Of course, I'm surprised. I certainly didn't see it coming to the magnitude as it has. And if I did, I probably would have oriented my portfolio a little bit differently. But I think what's gone on with SPACs, which we can talk about in much more detail, reflects very low interest rates, a fair amount of risk capital available today, and like so much that goes on in the investing world, a lemming-like behavior. So if one or two things take off, then the world jumps on it. Eventually, it will overwhelm it. But in the near term, what you get is a lot of people piling on, and that drives values even higher, and the flywheel effect starts to get going. And we've got that today. I lived through 1999, as did you, so I know that the elevator goes up and it comes down too. It's unclear when this elevator will come down and by how many floors, but it's likely at some point to come down.
One thing, Jeffrey, I was just reflecting on your career. Warburg Pincus was really the original private equity firm in energy. You guys did so many unique things. Newfield comes to mind. You were obviously doing it in conventional oil and gas. You guys did Cosmos, you did Spinnaker, you did some things which were what we would call today exploration or quote risky. Wow, has the world changed when it comes to capital availability? I mean, we went through a period of massive availability, and now we seem to be in a period where there's very little available to oil and gas. Is there, from your seat as having seen all those flows, do you think we're going to see capital flowing back into oil and gas if we get a good investment profile, or what? How would you forecast where we go from here, or how would you help us understand what's going on with all these capital flows?
I think long term you will see more flow coming back in, but the industry, I think, has to reset valuations so that the returns available to the capital, I'm thinking mostly equity, not debt, can return to, I'll call it a mid-teens level. And until that happens, I don't know that the capital flows will be overly strong. And certainly in the private world, most of the private equity firms that have dabbled in energy, they've either shrunk considerably or decided to go out of the business. So I think that the dynamic for I'll call it the business model that we financed at Warburg beginning in the late 80s with Joe Foster at Newfield, and then kind of put our foot on the accelerator in the 90s, which was back a few people, buy acreage, drill, prove up, and sell. I don't think that's a viable business model for the most part today. It'll exist on the edges, but not be the mainstream that so much of energy private equity was built upon.
It's funny you mentioned Joe. I was thinking in our lead-in when Mike was bullish, Matt was bullish, Jordan was bullish, Colin was bullish. I remember Joe Foster used to get questions. People would say, "Gosh, Joe, things look so good. What do you think?" And he'd say, "I don't know, but something always messes it up."
I feel very fortunate that I met Joe early in my energy-oriented career. I don't think that you could get a better educator and mentor than Joe, and then Roger Jarvis at Spinnaker, and on it went. And my former partner, Howard Newman, who many of your audience know, clearly deserves a lot of credit for what I think is creating the energy private equity business that we think of today. He was the leader.
No question. Well, maybe that's one question for you, Jeffrey, while we're on that, I think is because you've seen so many management teams and you just ticked off some of the great ones. Maybe share from your perspective as an investor, how much of a difference the team and the teamwork, the incentives, the machine, because sometimes we start thinking it's just assets and it's just prices, but the team, you guys always made a point of it's all about the team. I think that'd be interesting for everyone to hear your thoughts there.
Maynard, I don't think that's ever changed because it's a challenging business, even in the best of times. You have to have, I think, a management team that understands where it has to pivot, when it puts its foot on the accelerator, and when it puts its foot on the brake. If you don't have that, then you're solely reliant on the hydrocarbon price curve. And sometimes that works in your favor, but I don't think as an investor, that's something that you want to be counting on. So I always had a very strong bias to management. And then I've watched over my career, some of them have done a terrific job of adjusting as the world around them has adjusted. And they survived and prospered. And those that couldn't adapt, then not good things happen. So it's great to get the tailwind, but we also know you get headwinds. And it's really the management team that's got to lead the charge in thinking through what happens when the wind changes course.
Was there anything you always, as you were assessing management teams, that you had like a secrets of Jeffrey Harris in evaluating a team, or something you always look for, or something that you think people don't pay enough attention to?
I don't know if it's any special insight, but we were always very focused on people who were consistently intellectually curious and inquisitive, and were open-minded, that they weren't so dogmatic that they would get themselves into positions or into corners that they couldn't get out of as the world changed. And so a lot of our reference checking was to try and understand that aspect. And the second thing was to really try and appreciate what motivated them. Money doesn't have to be the motivator for great success. And I think our best management teams, sure, they were thrilled to make money, but they mostly wanted to prove that they could do it. And that's what we look for.
Wow, that's awesome. Well, one thing that we've been friends forever, and you've been good to our firm over the years. But one thing that triggered this is, meaning us roping you into this discussion, was you do an annual letter and think back on the year that was, and you wrote a great one this year as usual. And I think sharing some of those thoughts from your letter would be really interesting for people if you're up to that.
I'm happy to share some of that. And as you know, in the letter, it also can be irreverent. So a little careful.
Hey, we're ready. The subject line on this blast is going to be irreverent. We're ready. Well,
I started writing the letter when I left Warburg 9 years ago. I retired, as you mentioned, after 29 years there. And it was mostly an attempt to remind people that I still existed. And as I have been working with my friends over at Quantum Energy to develop our venture portfolio, it's a somewhat veiled attempt to ask people to bring us interesting investment opportunities as well. So that's what's really behind it.
As I went through it, you hit on, it was interesting to see what themes you hit on. And as I went through it, you talked about the big tech attack, some observations on energy and how hard it was, ESG as a unstoppable force, or how quickly it's moving, the kind of the battle with China, our democracy and how it seems to have delivered for us, even though sometimes it wasn't too pretty. And then just talked a little bit about, some of what you guys are doing in this space. But what do you make of this last year? Do you have any, when you had low moments last year, like we all did, what did you tell yourself to get through it? Or what analogy did you have to previous experiences, or what was your favorite podcast? I'm joking, but seriously, how did you survive the year?
So I spend a lot of time reading history, especially American history. And as challenging as 2020 has been, I think you can actually look back over the prior 200 years and realize America often has gone through periods of turmoil like 2020. And you don't even have to go to the Civil War, which clearly sits out on its own. But the politics of this country have almost always been chaotic. And the fact that the institutions are in place, the checks and balances are in place that keep it from totally flying off the guardrail. So there are times when, I don't know if you recall, when you took your kids to Disney World or Disneyland, and you'd be on the roller coaster, and then you'd realize that the wheels of the car and the roller coaster, they weren't at the front of the car, they were in the middle of the car. So you always felt like you were going to go right off into space. And I feel like that's kind of how we all have been feeling in America. But the wheels are there, they're actually on the track. And that's our institutions. So I've been looking back and reading history, and I in my letter, I often add some recommended reading. And one of the books I read was about Abraham Lincoln. and his train ride from Springfield to Washington, D.C. before his inauguration. And I had known for a long time that getting into Washington, D.C. was a tremendous challenge for him. I didn't realize there were 2 assassination attempts while he was on the train well before he got to Baltimore. And for those who don't know, when he got to Baltimore, his advisor said, or actually before he got to Baltimore, they said, you can't go into that station. So they took him off the presidential train, and in the middle of the night, they put him on a regularly scheduled train in disguise to sneak him into Washington. Otherwise, he would have been pulled off the train and killed. That was America. And there are other incidences like that. So to me, I got through it all by knowing it's been worse. And I feel strongly that to our betterment, the founding fathers put these checks and balances in with a lot of thought, and they've held, and they continue to hold. So it's been painful, but I never lost hope or confidence or thought the country was going to go into the toilet and never come out again.
Did you find yourself sometimes having to turn off the news and go read a book or go for a walk? I think we all probably in this environment started consuming too much information, but how did you manage it?
Actually, I never turned off the news. What I actually tried to do, which may be a little bit contrary, I live in New York. Manhattan went, I think 85 or 90% voted for Biden. So you could sense probabilistically where I ended up in all of that. But I actually took the opportunity to, instead of just listening to mainstream, MSNBC and CNN, which is clearly the dominant viewer experience in New York City, I started watching Fox because I tried to understand what the messaging was that was getting people so worked up. And I actually found that quite helpful, painful at times, but helpful to try to understand the issues in a better way. So I didn't run away to try and escape it. I actually jumped in to try and appreciate more of why the controversies were the way they were.
No, it's a great piece of advice for all of us, because you tend to think or believe your beliefs are directly related to your information sources. And so I think we got a couple of research analysts, a handful of them here on the phone. I'm sure they're always wondering about their information sources as they're trying to draw conclusions.
Well, I think you see it in a lot of things. I mean, those of your colleagues who reside in Houston with you, you get caught in your own bubble. And I'm not sure that that's always healthy or helpful. It's to Houston's credit, it's no longer a one industry town, but there's still a strong orientation there. And sometimes it's not in sync with the rest of the country.
Well, we probably spend a little more time thinking about why oil and gas prices might go up instead of why they might go down. That's one trend I've noticed in my own personal behavior.
Well, yeah, there's a natural affinity to being long. And it's important to have the optimism, I think, but it's got to be tempered too.
So you did mention some of the things you're doing in energy tech, what you're doing with quantum. Would you want to talk a little bit about that? Because I know you guys are seeing quite a few interesting things. What are the trends? What are the things that you find attractive as an investor?
So, first of all, the guys at Quantum have been terrific to work with. I've known Will Van Loo since before there was a Quantum Energy Partners, when he was actually had a little boutique of his own when he was in his 20s, trying to find money for E&P management teams. And when I retired from Warburg, Will and I sat down and developed called a more traditional advisory relationship. where I've been working with he and his colleagues and some of their portfolio companies. But about 3.5 years ago, I was able to persuade them to take some of their fund and dedicate it into the energy tech venture capital space. So we have a joint venture between myself and their firm to go do that. And our strategy is really very simple. We define energy in a very broad sense. And in today's world, that includes energy transition and sustainability. We have a long-term orientation, and we have the access to capital that Quantum's funds provide. And I think that allows us to be differentiated both from the venture capital firms in Silicon Valley who know a lot about venture but don't have a lot of domain expertise in the energy space. And because of my own background, able to go in and work with early stage companies in a way that's different from how private equity firms think. So that's the backdrop. We've invested in companies where our check size is 7 figures and 8 figures and 9 figures. So early, middle, and late stage venture. The most visible investment we have, which we made several years ago, was in a Silicon Valley company called ChargePoint, which is emerged as the leader in EV charging systems in North America, and they have a growing European presence. And the news of this year was, as the SPAC market, which you had mentioned earlier, began to blossom, we've now merged or announced a merger with ChargePoint with a SPAC. And we've gone through the entire process. And next month, we'll go through what's called the de-SPAC process. So the merger will be formally done and all the capital will flow. But it's been a really interesting adventure into SPAC world on one hand, and two, a different way to participate in the energy infrastructure and ecosystem than the traditional hydrocarbon based. And in fact, you would say it's, in some ways, it's a hedge against that. I actually don't think about it that way, but it's a step out from the tradition, and not something that Quantum would have done on its own by any means. And I'm doubtful that any of the energy private equity firms would have written a 9-figure check to go do something like that.
You know, Jeffrey, as I listen to the conversation, it reminds me of a story they tell at JP Morgan about the partners in the early 20th century. I forget if it was 1929 or some other bad event, but apparently the partners were all gathered around the ticker tape, and one of them muttered, "Life, it's just one damn thing after another." And it really sounds like, as a veteran, you can embrace that. And I guess squaring the circle on this question of secular versus cyclical, let's assume that 2020 is a trough both cyclically and on the secular cycle. And then we observe that we now have definitional changes. So when I say tech, I think most of us might think social media. They don't think direct air capture. They're not thinking ChargePoint. They're not thinking that tech. They're thinking this tech. And when we say energy, they often think oil and gas, but they may not be thinking blue hydrogen, even though blue hydrogen is natural gas. And it just feels like the definitions are all in motion. So based off your experience, when you see, the different tags getting attached to businesses, what's your perspective on that and what it might mean for what happens next?
Because I think that the mainstream, when they say tech, they're thinking of consumer-focused software companies for the most part. And that's a piece of it, but it's not the entire piece. And the way that we've tried to envision it is companies that apply technology as opposed to trying to do science to get patents, for example, but those who use technology in ways that can create a disruption in the economics of their users in a positive way. Now, a lot of times that is because of software and more advanced AI and machine learning kinds of things. but it's also totally different business models. Let me give you two examples. Our first investment that we made is in an Austin-based company called Rig Up. And Rig Up, I know, has been featured, Maynard, at your tech conference in prior years. The company got started focusing on, in essence, trying to be a B2B marketplace for oil field services and equipment. And I think they quickly realized that that wasn't a viable business model. And when we met them 3 years ago, they had begun to pivot to take advantage of one little kernel of business that they saw, which was around skilled labor. And there was an opportunity to be the marketplace for skilled labor as it impacted the oil field. And that's what we invested in. And they have built this software platform that makes it pretty seamless, both for industrial companies and skilled laborers to connect. And ChargePoint takes a small fee for putting them together and managing that relationship, including the flow of capital, including benefits for workers and the like. And it's a business that goes well beyond oil and gas. And to the company's credit, over the last 2 years, oil and gas has no longer been their primary vertical market. It's now renewables. Because an electrician that works in the oil field, he can work on a wind tower as well. And so there's some very powerful network effects that go with that, and some powerful operating leverage that goes with that. So to me, that's a great use of software platform technology to change the way that, in this case, contract skilled labor works with companies that need that. So that's one example. Another company that we invested in, which was last year, is in cybersecurity. And clearly, everybody understands the issue around it today. What was attractive to us about this company, which is called Dragos, and it's headquartered outside of Baltimore, founded by a bunch of former NSA people, is that most of the cybersecurity software in companies that have gotten the biggest mind share, they're focused on protecting the IT center. And what Dragos understood is that increasingly our industrial facilities are connected online and controlled online, even to the extent that a lot of the executives who run these companies don't clearly understand. And that layer needed security as well. And the initial target market were utilities and oil and gas facilities. And that's why we saw this connection to the energy space. Now, clearly, you can use that same technology of protecting those kinds of assets across all of manufacturing. And also, as you can imagine, quite an international opportunity. So that was a chance to go and tap into technology in a way that could address issues in the energy industry and more broadly, but in a way that didn't exist years ago. I'll stop there.
Well, that whole space is a fascinating space, and you've been a pioneer in it. So, gosh, we could talk so much about that space. I wanted to ask you one question, because you mentioned, we talked about news and information, and I think part of what we've been trying to do is, in energy, whether it's the transition or otherwise, but particularly around the transition, it's hard to get good information. It's hard to get good facts. It's hard to get good, reasonable analysis that doesn't have an agenda. Well, when you're looking for good information, good thought-provoking, centrist, if you will, I mean that as in centrism correlates with moderation, which correlates with maybe being correct. What are your news sources? Where do you go when you want really thoughtful pieces about energy and the energy transition?
In addition to Tudor Pickering.
Yes, sir. Thank you for that plug.
I don't think we have any special sources of data. Just part of, I guess, my training at Warburg Pincus was you just keep asking questions of people, and you don't stop. You just are relentless to trying to understand all the dimensions that you can. And the notion of due diligence is important, but I actually don't think it ends when your investment gets made. It just continues from that point on. So it's a constant search of trying to learn as much as you can. I don't think there's anything special about that other than to be dogmatic. Just go get as much information as you can, and you'll end up with competitive advantage if you do.
Well, it seems, that expression about be moderate in all things, including moderation. I think you just said be dogmatic, but be dogmatic about not being dogmatic when thinking back to your earlier comments.
Again, back
I
to
swear there's a joke in there somewhere, Jeffrey. I almost had it.
It's okay. I'm very fortunate that early in my career, I tested regularly by my more senior partners at Warburg Pincus. And it was grueling and painful at the time, but it was good training that you needed to be able to answer questions thoughtfully and then support the follow-up questions, or support the answers to the follow-up questions. And I don't think there's any way around that today.
And maybe one question, Jeffrey, from that, because I know we're probably getting short on time, but you've had a fantastic career. You've seen so much. One of the questions we're all asking ourselves today is, what will we as an industry, will the energy industry, the classic energy industry, get the talent? Will it get the college graduates and the grad school types, to join us and make us better? That's sort of a big question that's on everybody's mind. I think we know that all the exciting tech-driven things will get a lot of talent. What would you advise the industry on getting talented people to join it, the classic energy industry? And then the flip side, what would you advise young people to think about as they build a career? How should they approach it?
It's funny that you asked that question, because I had a conversation earlier today around that topic. And my children are past the age of trying to decide what their career is going to be. They're already focused and on their way. But I would look at those of you who have children who are in high school today. Would you advise them to become petroleum engineers or not? And I suspect most of you would not. So I think it creates an ongoing problem for the industry that already had the problem of being able to attract the best and the brightest. I don't think money is going to be the motivator to get people into these jobs. So you're going to have to create an environment that is particularly interesting in terms of the problems that they're being asked to solve, which I think can be done, but probably not anywhere near to the degree that it had been historically. So I actually think this should be amongst the industry's biggest concerns. That as this existing generation matures and retires, will they be able to fill those seats with other talented people? And to the extent that they're unable to, they're going to become much more reliant, which is not going to be a bad thing, on artificial intelligence and software and other tools to do a lot of that work. The good news is I think that the machine learning and the like can be helpful and leverage those people who are working in this space. So you may not need as many as you had in the past. But I don't think it's an area that you would naturally push your children into, even if you're in Houston.
There's another dimension to that. That's a problem for the companies, but it's a problem for all of society if we continue to demand tens of millions of barrels of oil and however many BCF of natural gas. I think one of the great concerns is by the time we get to the 2030s, the lack of investment in labor and capital will have human civilization very interested in having a petrochemical industry. But if the non-existence of the petroleum engineers, the mechanical engineers, et cetera, That's not a petroleum industry problem. That's a human problem, and it's global.
Oh, Colin, I think you're right. I don't know to what extent technology will replace the need for that quantity of hydrocarbons. And you all know much better than me how many hydrocarbons sit in the ground that have already been discovered that have not yet been produced. And I think the question is, will you need new exploration to keep society going past 2030, 2040, 2050? You all are better equipped than me to do that math. But you may find that you don't need to. And since it's a commodity, if it becomes scarce, the price will go up and people will find alternative ways to deal with things. So I hear your question and your concern. I think I'm probably a little less worried about it, which again is not going to make me popular in Houston.
Well, maybe the question is, the job of a petroleum engineer may not be subterranean in the year 2050. It may be atmospheric. It may be oceanic. It may be in botany, wherever the hydrogen is. So maybe we have to redefine the job of petroleum engineer. Yeah,
and I fall into the same trap as many when I think about the business. I think more of oil than natural gas, and I think they will have their own trajectories, and I don't think they're the same going forward. But it's an important distinction. But I don't think it's on the fact that if you're an intelligent, hardworking youngster today, what is going to grab your attention? And if your family didn't grow up in the oil and gas business, I don't think there's going to be a natural excitement to go there.
But Jeffrey, maybe as we're wrapping up, one last question occurs to me, which seems like it'd be a good place to end on. You look at the world and everything that we're talking about these days as it relates to energy. Do you think there's anything that we're not talking about that we should be? Any particular technology, a material issue, a trend? Do you feel like something, we talk about hydrogen a lot. We talk about a ton of things, everything that's possible in the digital world, but often kind of wonder, what is it should we be focusing a little more on that we're not talking about as much as we should?
I don't know if you're going to like this answer either, Maynard.
Well, let it rip. Yay, it's an open forum.
I struggle to think of an industry that has mismanaged its public relations more than the oil and gas space. And I think that the whole ESG movement, which I call a tsunami, and unlike anything I've seen in my career, is still in its early innings and going to pick up speed and force from here. It will be table stakes for every business. It will be a measurement for executives of all types in all industries and getting a bonus. And for me, watching the oil and gas industry continue to fight against it, I think is ridiculous. And flaring being the most obvious example today, where they're so far behind where society is going. It's beyond being a shame. It's just pathetic. And so to me, the industry's got to get ahead of these curves and recognize it and not be so short-term oriented in their thinking. If they don't change, then they're going to always be the bad boy. And that's got significant repercussions. And by the way, just to finish the thought and coming back to Colin, to what we were talking about, for a lot of people today who are thinking about their careers, whether they're in high school or much older, being associated with the hydrocarbon business is being on the dark side today. That's a problem. And I think that many in the industry make it worse because they don't acknowledge that. Or when they do, it's clear they're paying lip service to it. So for me, my area of emphasis is how do you get companies to embrace all of this ESG as opposed to try and giving it the straight arm?
Well, like you, Jeffrey, I'm sitting on the East Coast. I'm not sitting in Texas. And so you and I are living in similar zip codes. And I think, to be intellectually honest about it, part of the problem is that portrait has been deliberate. And it may not have been parried so well. It may not have been responded so well. It may not have been so proactive. But there has been a little bit of a deliberate attempt to paint hydrocarbons in that light. And what makes us nervous sometimes, I think, is the full demand picture. Fossil fuels is part of hydrocarbon demand, but especially in the age of COVID, as we've pointed out many times on this show, the demand for PPE is demand for hydrocarbon, wherever you may get it. And so what makes me nervous is I do not see people in Boston or New York fully understand that even now. And so we still get this talking past each other dynamic as the capital and labor, and the kids are not going into the industry, and the rest of us will be octogenarians looking for the cancer treatment, and it won't be there. It just won't be there. And you're right, the price will have to affect it, but the price will be astronomical, and then we have all sorts of other problems.
So I would just make the point. You just used the phrase fossil fuel, which we all in the oil and gas business recognize includes coal. How the oil and gas business ever allowed that terminology to be used and let themselves get sucked into that, as opposed to being more granular, because it's all different. And yes, you need hydrocarbons for plastics and the like, and we do need natural gas as a transition fuel. And the world needs this in spades and will for a long time because the industry is not going away. But that doesn't mean, in my opinion, that the industry can't behave more responsibly in things like methane and flaring, because it sets up the opportunity for the person in Boston that you referenced generically to say, you're just bad. And that's a mistake that the industry consistently makes.
Look, this is exactly why we wanted you on, Jeffrey, because you're a great friend. You've seen so much, and also we're here to stimulate thinking and not just sit in our own bubbles. But when you say the industry should engage on ESG, the takeaway I have on that is the industry should be calling itself out for things it's doing that it can do better. It should be its footprint should be as good as possible, and it should commit itself to that. And on top of that, it should be more proud of itself for all the things that it does accomplish and make possible. And it shouldn't run from the energy transition discussion, not that I think it is, but it should engage in it directly because it is part of the solution. And obviously this is a global debate. It's not just a debate for New York or Boston or Houston. We're honestly just a small part of the puzzle, and it's a global opportunities, global challenges. And so all of this needs to be put in a global context. And if there was one good thing about the election that we just went through, at least on an energy perspective, is that, natural gas kind of got its day. And what the U.S. has done with emissions is a fantastic thing. And that came from fracking, which is that message never gets out. It almost got out, but there's so much good to report. We've got to attack the bad and we got to amplify the good, I guess, is what I end up thinking to myself as I'm listening to you guys.
Maynard, I would just add that unless the industry acknowledges and deals with the bad, the history of the relationship of the industry with the generic public won't allow the goodness to come out. It gets smothered.
That's a fair point. Well, maybe we'll wrap up. Everybody has New Year's resolutions. let's all make one right now that by the end of 2021, we're going to help the industry with this message.
I think that you guys are very much advanced in your thinking about this, and I applaud what you've done broadly in this space, but also in the energy technology space. I don't know other firms that have put the resources into this that you all have. I think you're at the forefront. And over time, I suspect it will pay nice dividends for you, but it's important that groups like you help lead the thinking in all of this.
Well, you're very kind. I think for us, it fits that profile of it's a passion, and if it makes money, that'd be nice too. I'm going to tell all my partners, you know, they need to lighten up on this profitability stuff.
Good luck.
Anyway, Jeffrey, you've been wonderful. Thank you so much for everything. And you're a great friend, and we look forward to having you again, maybe this time next year, after you write the next letter. We'll look back on this show and we'll reflect on it and see how we did.
Well, thank you for putting up with my commentary.
We love you. Thank you, Jeffrey.